Hello my fellow investors and welcome to Invest Like a Guru. Today we're going to have a look at yet another couple of strategies that are quite well known in the investment community, and we'll have a look at how they are built, what the historic results are, and if we can get the same results in our testing system. In the upcoming videos we'll be having a look at if we can enhance these the profits, the performance of these strategies with some small changes. Now, the strategies we're going to have a look at today is called Mama Bear and Papa Bear. And the core idea here is to build a portfolio that is protecting you from being eaten alive by the bear market when it occurs. And yes, I know that some of you have only been investing for a few years and you hardly know what a bear market is. You have heard it talked about, but haven't really felt it in the stomach, waking up in the morning when the markets are imploding over a couple of years maybe, and wondering if it'll ever get back to a bull market. So that is what this strategy or these strategies are meant for, are these tough times when the market is dropping, where you want to keep some most of your profits in your portfolio, not losing 50 or 60 or 70% of your money. So let's have a look at it. First of all, these strategies have been tested back to 1973 and 1980. I'm not 100% certain where they are getting these numbers because what we are testing in our system, we are using the exact strategies and ETFs that are mentioned in the book Muscular Portfolios, where these two strategies are mentioned. And these ETFs only exist from around 2010-11-ish here. But I guess they have used some mutual funds back here, and it shows that it has been tested over 45 years, and it keeps turning out pretty much the same profits with the same volatility year over year, which is a good thing. We want something that is not only working in bull markets or in bear markets. We want something that can be spread over several decades and still turn out with some decent results. Now here are the Mama Bear and the Papa Bear. You can see there's a bit of difference in the performance. I'll explain to you in a second why. Now looking at the stats here, also back from 73 and 80, we can see that the Mama Bear portfolio here is turning out 13.3% in CAGR, and the Papa Bear is 13.2%, so basically the same. This is of course some stats over several decades, so there can be a lot of difference from decade to decade. Let's have a look at that later as well. We can see that the annualized volatility is 12 and 13%, so also basically the same here. They are comparing to a 60-40 benchmark, meaning 60% stocks and 40% bonds. And you can see here that the Sharpe ratio is higher than the benchmark in both cases here. You can see that the max drawdown, and that is end of month, that is 21% here. Now, this max drawdown end of month is a bit of a, in my opinion, a faulty way of doing this, because when you're only looking at the drawdowns once per month, there can be some huge drawdowns intra-month, and therefore in our test that you'll see in a second, we're looking at day-to-day drawdowns, meaning that the drawdowns are showing some larger variations. Alright, that's basically it. 13% here, a Sharpe ratio around 0.7 and a max drawdown around 20%. So let's have a look at what these strategies actually are, how they are built, and if we can find the same sort of performance when we are testing in our advanced system. Now, first of all, the Papa Bear portfolio, as mentioned here from the book Muscular Muscular Portfolios, and it is built on a white paper by Mebane Faber that I guess you know. He's quite well known in this portfolio construction community. Now, it is designed, the goal here is to keep losses small during a bear market, to underperform the S&P 500 with less volatility during bull market. And you might want to say, why would we want to underperform the S&P 500? Now, the key here is with less volatility, and that is what many people forget to look at, is that They fall in love with some high performance, but they forget to look at the high volatility as well. And the high volatility is what really kills you on the psychological note when the bear market hits. So we want some quite low volatility. That is also what we are aiming for in our normal stock portfolio. And number 3, wind up with a superior performance over each complete bear bull market cycle. All right, what does it do? Well, it has 17 asset classes here, and you can see these are all ETFs, for instance, the US Real Estate Investment Trust, VNQ, and so on. We have some commodities, some US large cap, small cap. We have some developed markets, gold, non-US sovereign and corporate bonds, high quality corporate bonds. We have some treasury bonds, treasury notes, and emerging market stocks. What it does is that once per month, it is looking at the average gain of each of these ETFs over 3, 6, and 12 months, and then average them up, and ending up, for instance, with the US Real Estate Investment Trust right now, the average of 3, 6, and 12 month here is 17.65%. It does that with all of these ETFs here, and ends up with the top 3. And what you do is you're looking at the top 3 once per month, and you are buying equal weight with around a third of your money in each of these 3 and leaving the rest of them. Now, next month, you're doing the exact same. If these 3 ETFs are still the top 3, then you do nothing. If one of them have dropped out and a new one has taken its place in top 3, you just sell the one that has dropped out and you buy the new one. It is as simple as that. It is even simpler than the dual momentum that we made videos about for a couple of weeks ago. So that is it. There are some more details explained down here, but I don't think it is needed. Basically, it is very simple. Now, can we get the same results as we saw, the 13% in KGAR, there's 0.7 in Sharpe ratio, and a max drawdown of 20% when we are looking at the Papa Bear since 2011? Have a look in the Invest Like a Guru system here. As you can see, we haven't been able to make this portfolio with the same KGAR, and that can easily be because we are only looking at around 10-11 years here. So it might be that this is just a decade with a bit lower KGAR, so that if we were able to scroll back 2 or 3 decades more, we would get the same KGAR. What you can see here is, and that is interesting, we are having pretty much the same Sharpe, so the Sharpe is holding up. The volatility also around the 13%. If we are looking at the Papa Bear here, which is the one we're looking at here, you can see Sharpe ratio 0.67, max drawdown at 21, and a volatility at 13.1. So that is basically also what we are getting here. We are getting a bit higher drawdown, max drawdown. And what my guess is that if these stats here, if they have been taken on a end of day basis instead of an end of month, these might have shown 30 to 40% drawdown. I don't know that for sure, but that is my guess, because intra-month they will have had to be showing some very larger or a lot larger drawdowns. If it is 30 or 40, I don't know, but it will be larger, no doubt about that. All right, so what can we see here? Max drawdown of 25%. We can see we have 61% winners. The average winner is 1.6 times the losers, so that is basically quite a decent system actually. And if you want something that only needs to be rotated once per month, you only need a couple of ETFs, 3 ETFs in this case, well then this is actually not a bad system, and we will track it on our Invest Like a Guru website so you can see if it keeps performing. We can see down here some the average month is making 0.8%. The average winning month is around 2.5. The average loser is 2.3. We can see the month by month data here, and what I like to see actually is also the quarterly performance, which is showing nice gains. I do note that in 2015 and 16 here, out of 8 quarters, it had 6 of them in the negative, which must have been a bit hard to stomach here. But again, if you have 45 years of data, I guess that you can trust the system pretty well. Let's have a look at the other one. This was the Papa Bear. Let's have a look at the Mama Bear. Now, what the Mama Bear is doing is pretty much the exact same thing. It is designed to keep losses small during bear markets, blah, 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 underperform the S&P with less volatility and wind up with superior performance. The exact same goals here, which is important when you construct a system. You need to know what is your goals. Now, what you can see here is that it only has 9 assets. So instead of having US large cap value, small cap growth, and so on, it only has commodities, real estate, US large cap stocks, gold, small cap stocks, treasury bills, developed market, large cap stocks, emerging markets, and 20 years bonds here. That is that. What it is doing is it is making things even simpler because in the Papa Bear, it was taking the average of 3, 6, and 12-month gain. What this one is doing is just taking the 5-month gain. How they ended up on the 5-month gain, I'm not 100% certain, but when we start to play a bit around with the numbers, we might want to see if we can change this factor here so that we get a better result, maybe the same results with lower volatility in the Mama Bear. That will be exciting to see. But otherwise, you can see the exact same setup. You're taking the 5-month gain, looking at the top 3, choosing these, and in a month you do the exact same thing. If these 3 are the same, you just keep them, and yeah, that's it. It doesn't take much. You can do much of these calculations with a simple chart and doing it in an Excel spreadsheet. Basically, we'll also be tracking this one, so you don't have to do it in an Excel spreadsheet. But then you just put equal weight into each of them. And let's see what we find of the results here. As you remember, in the Mama Bear, we had 13.3% per year, 0.7 in Sharpe ratio, max drawdown at 20. Let's see what we come up with. Now, what you see here is that we find the Mama Bear since 11 here, in the summer 2011, it is only making 8.7%. Now, that is compared to the 9.4% over 10, 11 years here. It makes the Papa Bear, the first one, is making 100,000 into 70,000 here. So around 170% altogether, whereas this one is making around 150%. So not that much of a difference, but there is 1.5% difference over the last 10 to 11 years here. The Sharpe ratio is a bit higher, and that is because that it has quite a lot lower volatility. The volatility here in the Papa Bear was 13%, whereas in the Mama Bear it was only 11.2%. You can also see that the max drawdown here was 25%, whereas the max drawdown in the Mama Bear was only 16.3%. So at least since 2011, if you are going for a bit less volatility, some more certainty in your portfolio, and you're willing to give up a bit of your CAGR, a bit of your yearly performance, but have a more stable line in your equity here, then the Mama Bear might be the one to go for. But as you can see, the numbers are basically the same. The CAGR are lower, again, a lot lower actually than the 13.23% we saw in the original. But again, if we're looking at this model again in a decade, it might show up with maybe 15% in CAGR, who knows. Again, 61% winners, 1.67 times the average winner is 1.67 times the average loser, so it's basically the same. So the difference between the Mama Bear and the Papa Bear in the original paper here was not much. It was basically the same, around 13% here, 0.7 in Sharpe, around the same max drawdown. And what we have found over the last decade is we can only get it to make around 8, 9, a bit more in the annualized return. So that is 4% below the historic return they have found. The Sharpe ratio is about the same, but we are finding some larger drawdowns, at least in the Papa Bear. In the Mama Bear, we only saw a max drawdown over the last decade of around 16%. So we will be tracking these, and as I said in the next video about the Mama and Papa Bear, we will be trying to see if we can squeeze a bit more out of these very simple strategies. That's all for now. I hope this was educational to you. I'll drop a link to our website below if you want to sign up. We have our own stock system, as you know, momentum systems, and a couple of ETF systems. And you can follow that as a member. There's a 30 days free trial that you can test. And you're welcome in there. And we are answering all questions that is asked on on email, on the Facebook site, or wherever you find us. That's all for now. Take care of yourself and your money out there, and I'll talk to you again shortly. Bye.